limited, but the world has developed in a different way. On your question about I will just say I'm a card-carrying capitalist, but I believe we wouldn't be sitting here except for the market system and the rule of law and some things that are embodied in this country. So you don't have to worry about me changing in that manner, but I also think that capitalism does involve regulation. It involves taking care of people who are left behind, particularly when the country gets enormously prosperous. But beyond that, I have no Berkshire podium for pushing anything. Charlie?
Well, I think we're all in favor of some kind of a government social safety net in a country as prosperous as ours. What a lot of us don't like is the vast stupidity with which parts of that social safety net are managed by the government. It'd be much better if we could do it more wisely. But I think it also might be better if we did it more liberally.
Yeah, one of the reasons we're involved in this effort, along with J.P. Morgan and Amazon, with Jamie Dimon and Jeff Bezos, on the medical question, is we do have as much money going, 3.3 or 3.4 trillion. We have as much money going to medical care as we have funding the federal government, and it's gone from 5 to 17% or 18%, while actually the amount going to the federal government has stayed about the same at 17%. So we hope there's some major major improvements from the private sector, because I generally think the private sector does a better job than the public sector in most things. But I also think that if the private sector doesn't do something, you'll get a different sort of answer. And I like to think that the private sector can come up with a better answer than the public sector in that respect. But I will probably, it depends who's nominated, but I voted for plenty of Republicans over the years. I even ran for delegate to the Republican National Convention in 1960. But we are not. I don't think the country will go into socialism in 2020 or in 2040 or 2060. Okay, Greg Warren.
Warren, my first question, not surprisingly, is on share repurchases. Stock buybacks in the open market are a function of both willing buyers and sellers. With Berkshire having 2 shares of classes, you should have more flexibility when buying back stock. But given the liquidity difference that exists between the 2 share classes, with an average of 313 Class A shares exchanging hands daily the past 5 years, equivalent to around $77 million a day, and an average of 3.7 million Class B shares doing the same, equivalent to around 622 million, Berkshire is likely to have more opportunities to buy back Class B shares than Class A, which is exactly what we saw during the back half of last year and the first quarter of 2019. While it might be more ideal for Berkshire to buy back Class A shares, allowing you to retire shares with far greater voting rights, given that there's relatively little arbitrage between the 2 share classes and the number of Class B shares increase every year as you gift your Class A shares to the Bill and Melinda Gates Foundation and your children's foundations, can we assume that you're likely to be a far greater repurchaser of Class B shares going forward, especially given your recent comments to the Financial Times about preferring to have loyal individuals on your shareholder list, which a price tag of $328,000 of Class A shares seems to engender?
Yeah, we will, when we're repurchasing shares, if we're purchasing substantial amounts, we're going to spend a lot more on the Class B than the Class A, just because the trading volume is considerably higher. We may, from time to time, well, we got offered a couple blocks in history, going back in history, from the Yolshi estate, and when we had a transaction exchanging our Washington Post stock for both a television station and shares held by the Washington Post. So we may see some blocks of A, we may see some blocks of B, but there's no question if we are able to spend 25, 50, or $100 billion in repurchasing shares, more of the money is almost certainly going to be spent on the B than the A. We don't. There's no master plan on that other than to buy aggressively when we like the price. And as I say, the trading volume in the B is just a lot higher than the A in dollar amounts. Charlie?
I don't think we care much which class we buy.
Yeah. We would like, we really want the stock, ideally, if we could do it, if we were small. Once a year we'd have a price, and we'd do it like a private company, and it would be a fair price, and people who wanted to get out could get out. And if other people wanted to buy their interest, fine, and if they didn't and we thought the price was fair, we'd have the company repurchase it. We can't do that. But we don't want the stock to be either significantly underpriced or significantly overpriced, and we're probably unique on the overpriced part of it. But we don't want it. I do not want the stock selling at twice what it's worth, because I'm going to disappoint people. We can't make it. There's no magic formula to make a stock worth what it's selling for if it sells for way too much. We don't, from a commercial standpoint, if it's selling very cheap, we have to like it and we repurchase it. But ideally, we would hope the stock would sell in a range that more or less is its intrinsic value, business value. We have no desire to hype it in any way, and we have no desire to depress it so we can repurchase it cheap. But the nature of markets is that things get overpriced and they get underpriced, and we will, if it's underpriced, we'll take advantage of it. Okay, station 3.
Hello, Charlie Munger and Warren Buffett, my idols. I'm Terry from Shanghai Judge PE Fund, which aim to catch the best investment opportunity in next era. So my question is, as we all know, 5G is coming. It is said that the mode of all industry will be challenged in 5G era. So what is the core competence that we should master if Berkshire Hathaway wants to catch the best investment opportunities in next era? Thank you.
Well, there's no core competence at the very top of Berkshire. The subsidiaries that will be involved in developments relating to 5G or any one of all kinds of things that are going to happen in this world, the utility of LNG in the railroad, or all those kinds of questions. We have people in those businesses that know a lot more about them than we do, and we count on our managers to anticipate what is coming in their business, and sometimes they talk to us about it. But we do not run that on a centralized basis. And Charlie, do you want to have anything to add to that? Do you know anything about 5G? I don't know. But you probably know a lot about 5G.
No, I know very little about 5G. But I do know a little about China. And we have bought things in China, and my guess is we'll buy more.
Yeah. But, we basically want to have a group of managers, and we do have a group of managers who are on top of their businesses. You saw something that showed BNSF and Berkshire Hathaway Energy and Lubrizol all there. Those people know their businesses. They know what changes are likely to be ahead. Sometimes they find things that they can cooperate on between their businesses, but we don't try to run those from headquarters. And that may have certain weaknesses at certain times. I think net it's been a terrific benefit for Berkshire. Our managers, to a great degree, own their businesses, and we want them to feel a sense of ownership. We don't want them to be lost in some massive conglomerate and where they get directions from this group, which is a subgroup of that group. And I could tell you a few horror stories from companies we bought when they tell us about their experience under such an operation. So the world is going to change in dramatic ways. Just think how much it's changed in the 54 years that we've had Berkshire. And some of those changes hurt us. They hurt us in textiles. They hurt us in shoes. They hurt us in the department store business. Hurt us in the trading stamp business. These were the founding businesses of this operation. But we do adjust, and we've got a group overall of very good businesses. We've got some that will be actually destroyed by what happens in this world. But that's, I still am the card-carrying capitalist, and I believe that's a good thing. You have to make changes. We had 80% of the people working on farms in 1800. And if there hadn't been a lot of changes, and you needed 80% of the people in the country producing the food and cotton we needed, we would have a whole different society. So we welcome change, and we certainly want to have managers that can anticipate and adapt to it, but sometimes we'll be wrong, and those businesses will wither and die, and we better use the money someplace else. Okay, Carol. Sure, you haven't had any peanut brittle lately.
This question comes from Vincent James of Munich, Germany. There has been a lot written about the recent impairment charge at Kraft Heinz. You were quoted as stating that you recognize that Berkshire overpaid for Kraft Heinz. Clearly, major retail chains are being more aggressive in developing house brands. In addition, Amazon has announced intentions to launch grocery outlets, meaning that, as Mr. Bezos has often stated, your margin is my opportunity. The more fundamental question related to Kraft Heinz may be whether the advantages of the large brands and the zero-based budgeting that 3G has applied are appropriate and defensible at all in consumer foods. In other words, will traditional consumer good brands in general, and Kraft Heinz in particular, have any moat in their future? My question is, to what extent do the changing dynamics in the consumer food market change your view on the long-term potential for Kraft Heinz?
Yeah, actually what I said was we paid too much for Heinz. I mean Kraft, I'm sorry. The Heinz part of the transaction, when we originally owned about half of Heinz, we paid an appropriate price there, and we actually did well. We had some preferred redeemed and so on. We paid too much money for Kraft. To some extent, our own actions had driven up the prices. Now, Kraft Heinz, the profits of that business, $6 billion, we'll say very, very, very roughly. I'm not projecting them out. I'm not making forecasts, but $6 billion pre-tax on $7 billion of tangible assets is a wonderful business. But you can pay too much for a wonderful business. We bought See's Candy, and we made a great purchase as it turned out, and we could have paid more. But there's some price at which could have bought even See's Candy and it wouldn't have worked. So the business does not know how much you paid for it. I mean, it's going to earn based on its fundamentals, and we paid too much for the Kraft side of Kraft Heinz. Additionally, the profitability has basically been improved in those operations over the way they were operating before. But you're quite correct that Amazon itself has become a brand. Kirkland at Costco is a $39 billion brand. Now, all of Kraft Heinz does $26 billion, and it's been around on the Heinz side, it's been around for 150 years. It's been advertised billions and billions of dollars in terms of their products, and they go through tens of thousands of outlets. And here's somebody like Costco establishes a brand called Kirkland, and it's doing $39 billion, more than virtually any food company. And that brand moves from product to product, which is terrific if a brand travels. I mean, Coca-Cola moves it from Coke to Cherry Coke and Coke Zero and so on. But to have a brand that can really move, and Kirkland does more business than Coca-Cola does. And Kirkland operates through 775 or so stores. They call them warehouses at Costco, and Coca-Cola's through millions of distribution outlets. So brands, the retailer and the brands have always struggled as to who gets the upper hand in moving a product to the consumers. And there's no question in my mind that the position of the retailer relative to the brands, which varies enormously around the world in different countries, you've had 35%, even maybe 40% be private label brands in soft drinks, and it's never gotten anywhere close to that in the United States. So it varies a lot. But basically certain retailers, the retail system has gained some power, and particularly in the case of Amazon and Walmart and their reaction to it, and Costco, and Aldi and some others I can name, has gained in power relative to brands. Kraft Heinz is still doing very well operationally, but we paid too much. We paid $50 billion, it would have been a different business. It'd still be earning the same amount. You can turn any investment into a bad deal by paying too much. What you can't do is turn any investment into a good deal by paying little, which is sort of how I started out in this world. But the idea of buying the cigar butts that are declining or poor businesses for a bargain price is not something that we try to do anymore. We try to buy good businesses at a decent price, and we made a mistake on the Kraft part of Kraft Heinz. Charlie?
Well, it's not a tragedy that out of two transactions, one worked wonderfully and the other didn't work so well. That happens.
The reduction in costs, there can always be mistakes made when you've got places and you're reorganizing them to do more business with the same number of people. And we like buying businesses that are efficient to start with, but the management, the operations of Kraft Heinz have been improved under the present management overall. But we paid a very high price in terms of the Kraft part. We paid an appropriate price in terms of Heinz. Jonathan?
Internet-based furniture retailers like Wayfair appear willing to stomach large current losses acquiring customers in the hope of converting them to loyal online shoppers. I've been wondering what this disruptive competition might do to our earnings from home furnishing retail operations like Nebraska Furniture Mart. If we have to transition to more of an online model, might we have to spend more heavily to keep shoppers without a corresponding increase in sales? The sharp decline in first quarter earnings from home furnishings suggests perhaps some widening impact from intensifying competition. Do you believe Wayfair's customers first, profits later model is unsustainable, or do you think our furniture earnings will likely be permanently lower than they were in the past?
I think furniture, the jury's still out on that, whether the operations, which have grown very rapidly in size, but still are incurring losses, how they will do over time. It is true that in the present market, partly because of some successes, like most dramatically Amazon in the past, that investors are willing to look at losses as long as sales are increasing and hope that there will be better days ahead. We do a quite significant percentage of our sales online in the furniture operation. That might surprise you. We do the highest percentage in Omaha, and what's interesting is that we I won't give you the exact numbers, but it's large. We do a significant dollar volume, but a very significant portion of that volume people come to the store to pick up, so that they will order something from us online, but they don't mind. They don't seem to mind at all, and they don't have to do it, but they get a pickup at the store. So, you learn what customers like, just like people learned in fast food. That people would buy a lot of food by going through a drive-in, that they don't want to stop and go into the place. We learn about customer behavior as it unfolds, but we did do now on Tuesday we did 9.2 million or 9.3 million of profitable volume at the Nebraska Furniture Mart, and I think that company had paid in capital of $2,500, and I don't think anything's been added since. So it's working so far. The first quarter, it's interesting, the first quarter was weak at all four of our furniture operations. But there's certain other parts of the economy, just home building generally. It's considerably below what you would have expected, considering the recovery we have had from the 2008-9 period. I mean, if you look at single-family home construction, the model has shifted more to people living in apartment rentals. I think it's gone from 69 and a fraction percent. It got down to 63%. It's bounced up a little bit, but people are they're just not building or moving to houses as rapidly as I would have guessed they would have, based on figures prior to 2008 and 9, and considering the recovery we've had, and considering the fact that money is so cheap, and that has some effect on our furniture stores. I think we've got a very, very good furniture operation, not only at the Nebraska Furniture Mart, but at other furniture operations. And we will see whether the models work over the long run, but I think they have a reasonable chance. Some things we're learning that people will buy some things that they've always gone to the mall or to a retail outlet to buy, that they will do it online, and others don't work so well. Charlie?
I think that we'll do better than most furniture retailers.
I think that's a certainty.
Yeah.
Overall,
Yeah.
overall, we've got some good operations there, and but we don't want to become a showroom for the online operations and have people come and look around the place and then order someplace else. So we have to have the right prices, and we're good at that at the Furniture Mart. Station 4.
Warren and Charlie, My name is Brent Muyo. I'm from Winnipeg, Canada. First, thank you for devoting so much time and energy to education. I'm a better investor because of your efforts. But more importantly, I'm a better partner, friend, son, brother, and soon-to-be first-time father. There's nothing more important than these relationships, and my life is better because you're willing to pass on your experience and wisdom. My path into finance was unconventional. I worked as an engineer for 12 years, while 2 years ago I began a career in finance, working for the Civil Service Superannuation Board, a $7 billion public pension fund in Winnipeg. I work on alternative investments, which include infrastructure, private equity, and private credit. I go to work every day knowing that I'm there to benefit the hardworking, current, and future beneficiaries of the fund. Like most asset classes, alternative purchase multiples have increased. More of these assets are funded with borrowed money, and the terms and covenants on this debt are essentially non-existent. With this in mind, and knowing the constraints of illiquid, closed-end funds, please give me your thoughts on private alternative investments, their relevancy in public pension funds, and your view on long-term return expectations.
Yeah, if you would leveraged up investments in just common stocks, and you'd figured a way so that you would have staying power if there were any market dip. I mean, you'd obviously have obtained extraordinary returns. I pointed out in my investing lifetime, an index fund would do 11%. Well, imagine how you'd have done if you'd leveraged that up 50%, whatever the prevailing rates were over time. So a leveraged investment in a business is going to beat an unleveraged investment in a good business a good bit of the time. But as you point out, the covenants to protect debt holders have really deteriorated in the business. And of course, you've been in an up market for businesses, and you've got a period of low interest rates. So it's been a very good time for it. My personal opinion is if you take unleveraged returns against unleveraged common stocks, I do not think what is being purchased today and marketed today would work well. But if you can borrow money, if you can buy assets that will yield 7 or 8%, and you can borrow enough money at 4 or 5%, and you don't have any covenants to meet, you're going to have some bankruptcies, but you're going to also have better results in many cases. It's not something that interests us at all. We are not going to leverage up Berkshire. If we'd leveraged up Berkshire, we'd have made a whole lot more money, obviously, over the years. But both Charlie and I probably have seen some more high IQ people, really extraordinarily high IQ people, destroyed by leverage. We saw long-term capital management where we had people who could do in their sleep math that we couldn't do, or at least I couldn't do, working full-time at it during the day. And I mean, really, really smart people working with their own money and with years and years of experience of what they were doing. And it all turned to pumpkins and mice in 1998, and actually was a source of national concern, just a few hundred people. And then we saw some of those same people, after that happened to them once, go out and do the same thing again. So it's I would not get excited about so-called alternative investments. You can get all kinds of different figures, but there's probably at least $1 trillion committed to buying, in effect, buying businesses. And if you figure they're going to leverage them, 2 for 1 on that, you may have $3 trillion of buying power trying to buy businesses in the U.S. market may be something over $30 trillion now, but there's all kinds of businesses that aren't for sale in that thing. So the supply-demand situation for buying businesses privately and leveraging them up has changed dramatically from what it was 10 or 20 years ago. And I'm sure it doesn't happen with your Winnipeg operation, but we have seen a number of proposals from private equity funds where the returns are really not calculated in a manner that, they're not calculated in a manner that I would regard as honest. And so it's not something. If I were running a pension fund, I would be very careful about what was being offered to me. If you have a choice in Wall Street between being a great analyst or being a great salesperson, the salesperson is the way to make it. If you can raise $10 billion in a fund and you get a 1.5% fee and you lock people up for 10 years, you and your children and your grandchildren will never have to do a thing if you are the dumbest investor in the world. Charlie?
Well, I think what we're doing will work more safely than what he's doing. But I wish him well.
Yeah, Brent, you sound like a guy that I would hope would be working for a public pension fund, because frankly, most of the institutional funds, we had this terrible right here in Omaha, and you can get a story of what happened with our Omaha Public Schools retirement fund, and they were doing fine, and until the manager started going in a different direction, and the trustees here, perfectly decent people, and the manager done okay to that point, and it became.
They were smarter in Winnipeg than they are here.
Yeah, well,
that was pretty bad here.
It's not a fair fight, actually, usually when a bunch of public officials are listening to people who are motivated to, who really just get paid for raising the money. Everything else is gravy after that. But if you run a fund and you get even 1%, of a billion, you're getting $10 million a year coming in, and if you've got the money locked up for a long time, it's a very one-sided deal. And I told the story of asking the guy one time in the past, why in the world can you ask for 2 and 20 when you really haven't got any kind of evidence that you are going to do better with the money than you do in an index fund? And he said, well, that's because I can't get 3 and 30.
What I don't like about a lot of the pension fund investment is I think they like it because they don't have to mark it down as much as it should be in the middle of the panics. I think that's a silly reason to buy something, because you're given leniency in marking it down.
Yeah, and when you commit the money, in the case of private equity often, they don't take the money, but you pay a fee on the money that you've committed. And of course, you really have to have that money to come up with it at any time. And of course, it makes their return look better if you sit there for a long time in treasury bills, which you have to hold because they can call you up and demand the money, and they don't count that. They count it in terms of getting a fee on it, but they don't count it in terms of what the so-called internal rate of return is. It's not as good as it looks, and I really do think that when you have a group sitting as a state pension fund,
Warren, all they're doing is lying a little bit to make the money come in.
Yeah, well, that sums it up.
Yeah.
Becky?
This question is from Ken Scarbeck in Indianapolis. He says, with the full understanding that Warren had no input on the Amazon purchase and that relative to Berkshire, it's likely a small stake, The investment still caught me off guard. I'm wondering if I should begin to think differently about Berkshire looking out, say, 20 years. Might we be seeing a shift in investment philosophy away from value investing principles that the current management has practiced for 70 years? Amazon is a great company, yet it would seem its heady shares 10 years into a bull market appear to conflict with being fearful when others are greedy. Considering this and other recent investments like StoneCo, should we be preparing for a change in the price versus value decisions that built Berkshire?
Yeah, it's interesting that the term value investing came up, because I can assure you that both managers and one of them bought some Amazon stock in the last quarter, which will get reported in another week or 10 days. He is a value investor. The idea that value is somehow connected to book value or low price earnings ratios or anything, as Charlie has said, all investing is value investing. I mean, you're putting out some money now to get more later on, and you're making a calculation as to the probabilities of getting that money and when you'll get it and what interest rates will be in between, and all the same calculation goes into it, whether you're buying some bank at 70% of book value or you're buying Amazon at some very high multiple of reported earnings. Amazon, the people making the decision on Amazon are absolutely much value investors, as I was when I was looking around for all these things selling below working capital years ago. So that has not changed. The two people that, one of whom made the investment in Amazon, they are looking at many hundreds of securities, and they can look at more than I can because they're managing less money and their possible universe is greater. But they are looking for things that they feel they understand what will be developed by that business between now and Judgment Day in cash. And it's not sales. Current sales can make some difference. Current profit margins can make some difference. Tangible assets, excess cash, excess debt, all of those things go into making a calculation as to whether they should buy A versus B versus C. And they are absolutely following value principles. They don't necessarily agree with each other or agree with me, but they are very smart. They are totally committed to Berkshire, and they're very good human beings on top of it. So I don't second guess them on anything. Charlie doesn't second guess me on. In 60 years, he's never second guessed me on an investment. And the considerations are identical when you buy Amazon versus some, say, bank stock that looks cheap statistically against book value or earnings or something of the sort. In the end, it all goes back to Aesop, who in 600 BC said, that a bird in the hand is worth two in the bush. And when we buy Amazon, we try and figure out whether, or the fellow that bought it tries to figure out whether there's 3 or 4 or 5 in the bush, and how long it'll take to get to the bush, how certain he is that he's going to get to the bush, and then who else is going to come and try and take the bush away, and all of that sort of thing. And we do the same thing, and it really, despite a lot of equations you'll learn in business school, the basic equation is that of Aesop, and your success in investing depends on how well you were able to figure out how certain that bush is, how far away it is, and what the worst case is. Instead of two birds being there, only one being there, and the possibilities of 4 or 5 or 10 or 20 being there. And that will guide me, that will guide my successors in investment management at Berkshire, and I think they'll be right more often than they're wrong. Charlie?
Well, Warren and I are a little older than some people, and
you're everybody.
And we're not the most flexible, probably, in the whole world. And of course, if something as extreme as this internet development happens and you don't catch it, why, other people are going to blow by you. And I don't mind not having caught Amazon early. The guy is kind of a miracle worker. It's very peculiar. I give myself a pass on that. But I feel like a horse's ass for not identifying Google better. I think Warren feels the same way.
Yeah.
We screwed up.
He's saying we blew it. Yeah. And we did have some insights into that because we were using them at GEICO and we were seeing the results produced, and we saw that we were paying $10 a click or whatever it might have been for something that at a marginal cost of them it was exactly zero, and we saw it was working for us. So
we can see in our own operations how well that Google advertising was working, and we just sat there sucking our thumbs.
Right.
So we're ashamed. We atone. We're trying to atone. Maybe Apple was atonement.
When he says sucking our thumbs, I'm just glad he didn't use some other example. Okay, Jay. Okay, Jay.
This question is on Berkshire's intrinsic value. Warren, in your most recent annual letter, you discussed a methodology to estimate Berkshire's intrinsic value. However, a major component of Berkshire's value that many investors find challenging to estimate is that of the company's vast and unique insurance business. Could you discuss how you value the company's insurance unit based on information Berkshire provides, especially since GAAP book value is not disclosed of the insurance unit?
Well, our insurance business gives us a float that's other people's money which we're temporarily holding but which gets regenerated all the time. So as a practical matter, it has a very, very long life, and it's probably a little more likely to grow than shrink. So we have $124 billion that people have given us, and that's somewhat like having a bank that just consists of one guy, and people come in and deposit $124 billion and promise not to withdraw it forever. And we've got a very good insurance business. It's taken a very long time to develop it, very long time. In fact, I think we probably have the best property casualty operation, all things considered, in the world that I know of any size. So it's worth a lot of money. It's probably, we think it's worth more to us, and we particularly think it's worth more while lodged inside Berkshire. We'd have a very, very high value on that. I don't want to give you an exact number because I don't know the exact number, but and any number I would have given you in the past would have turned out to be wrong on the low side. We have managed to earn money on money that is given to us for nothing, and have the side earnings from underwriting, and then have these large earnings from investing. And it's an integral part of Berkshire. There's a certain irony to insurance that most people don't think about, but if you really are prepared and you have a diversified property casualty insurance business, a lot of property business in it, if you're really prepared to pay your claims under any circumstances that come along in the next 100 years, you have to have so much capital in the business that it's not a very good business. And if you really think about a worst case situation, the reinsurance, that's the insurance you buy from other people as an insurance company to protect you against extreme losses, among other things, that reinsurance probably could likely be not good at all. So even though you think you're laying off part of the risk, if you really take the worst case example, is you're not laying off. You may well not be laying off the risk. And if you keep the capital required to protect against that worst case example, you'll have so much capital in the business that it isn't worthwhile. Berkshire is really the ideal form for writing the business because we have this massive amount of assets that in many cases are largely uncorrelated with natural disasters. And we don't need to buy reinsurance from anybody else. And we can use the money in a more efficient way than most insurance companies. It's interesting, in the last 30 years, the three largest reinsurance companies, and I'm counting Lloyd's as one company, although it isn't. It's a group of brokers assembled and underwriters assembled at a given location. But people think of Lloyd's as a massive reinsurance market, which it is, not technically one entity. But if you take the three largest companies, and they're all in fine shape now, they're first-class operations, but all three of them came close to extinction sometime in the last 30 years, reasonably close. And we didn't really have any truly extraordinary natural catastrophes. The worst we had was Katrina, and whatever it was, 2006 or thereabouts, 2005. But we didn't have any worst case situation. And all three of those companies, which everybody looks at as totally good on the asset side if you show a recoverable from them, two of the three actually made some deals with us to help them in some way. And they're all in fine shape now. But it's really not a good business if you keep as a standalone insurer, if you keep enough capital to really be sure you can pay anything that comes along under any kind of conditions. And Berkshire can do that, and it can use the money in ways it likes to use. So it's a very valuable asset. I don't want to give you a figure on it, but we would not sell it. We certainly wouldn't want to sell it for its float value. And if that float is negative, it's shown on the balance sheet as a liability. So it's extraordinary. And it's taken a long time to build. It'd be very, very, very hard for anybody I don't think they could build anything like it. It just takes so long. And we continue to plow new ground. If you went in the next room, you would have seen something called 3, which is our movement toward small and medium business owners for commercial insurance. And it's an online operation. And we'll do all kinds of mid-course adjusting and that sort of thing. And we're only just started up in 4 states. But 10 or 20 years from now, that will be a significant asset of Berkshire, just like GEICO is growing from $2.25 billion of premium to, who knows, but well into the mid-30 billion, just with Tony Nicely. And when I said in the annual report that Tony Nicely, who's here today.
Warren, is there anybody in the world who has a big casualty insurance business that you'd trade our business for theirs?
No, we really, it's taken a long time, and it's taken some tremendous people. And Tony Nicely has created more than 50 billion with his associates, and he's got 39,000 of them, probably more now because he's growing this year. He's created more than $50 billion at GEICO of value for Berkshire.
It's pretty much what you'd expect. It's such an easy business, taking in money now in cash and just keeping the books and giving a little of it back. There's a lot of stupidity gets into it. And if you're not way better than average at it, you're going to lose money in the end. It's a mediocre business for most people. And it's good at Berkshire only because we're a lot better at it. And if we ever stop being a lot better at it, it wouldn't be safe for us either.
And Ajit Jain has done a similar thing. He's done it in a variety of ways within the insurance business. But I would not want to undo, if somebody would have to give me more than $50 billion to undo everything he has produced for Berkshire. And he walked into my office on a Saturday in the mid-1980s. He'd never been in the insurance business before. And I don't think there's anybody in the insurance world that doesn't wish that he'd walked into their office instead of ours at Berkshire. It's been extraordinary. It's surely been extraordinary. But we have Tom Nerney, we have Tim Kennedy, we have at MedPro, we have Tom Nerney at U.S. Liability. We have at Guard Insurance. We only bought that a few years ago, and that's a terrific operation. It's based in Wilkes-Barre, Pennsylvania. Who would expect to find a great insurance operation in Wilkes-Barre? But we've got a great insurance, really great insurance operation right here in Omaha, about 2 miles from here. And it was bought by us in 1967, and it changed. It changed Berkshire. We built on that base. We've really got a great insurance business, and I won't give you a number, but it's probably a bigger number than you've got in your head and it's worth more within Berkshire than it would be worth as an independent operation. Somebody can say, well, this little gem, if it was put out there, would sell at a higher multiple or something of the sort. It works much better as being part of a whole, where we have had two tiny insurance operations many years ago, and they both went broke. The underwriting was bad, but we paid all the claims. We did not walk away. We paid every dime of claims, and nobody worries about doing any kind of financial transaction with Berkshire. And today on Saturday, about 9 in the morning, I got a phone call, and we made a deal the next day committing Berkshire to pay out $10 billion, come hell or high water, no outs for material adverse change or anything like that. And people know we'll be there with $10 billion, and they know in the insurance business, when we write a policy that can't be payable during the worst catastrophe in history, or maybe payable 50 years from now, they know Berkshire will pay. And that's why we've got $124 billion afloat. Okay, station 5.
Hey, Warren and Charlie. I'm Neil Nerona. I'm 13 years old and from San Francisco. I feel like I see you in our living room a lot. My dad is constantly playing these videos of you at these meetings. And he teaches me a lot of lessons about you guys. But many of them require the delayed gratification skill. I want to know, is there any way that kids can develop the delayed gratification skill?
I'll take it if you want me to, Warren.
Or could.
I'll take that because I'm a specialist in delayed gratification. I've had a lot of time to delay it. And my answer is that they sort of come out of the womb with the delayed gratification thing, or they come out of the womb where they have to have everything right now. And I've never been able to change them at all. So we identify it, we don't train.